We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lawrence Lepard from EMA2 Equity Management Associates. How are you today, Larry?
I'm great, Tom. How are you? Nice to have me on your show.
Great to have you back here, Larry. And of course, you and I usually talk around your quarterly letter releases. We're just coming up on the next one here. But, one of the phrases that I liked from your last quarterly report was that there are big rivets popping, which,
Yeah.
seems kind of appropriate considering the recent headlines of the submarine that was lost during that trip to the
Oh,
Titanic.
I know. What a tragedy. That's so sad.
So
Yeah.
what were these rivets that were popping, and are they just a warning of more to come?
Yeah. Well, obviously, probably the largest recent one that we can all point to was in mid-March when Silicon Valley Bank rapidly, there was a bank run, a virtual bank run, 42 billion one day, 100 billion requested the next day, and they were in receivership, to be followed by other banks, Silvergate, et cetera. And, we had two or three of the largest bank failures in history all occur within a couple of weeks. Ultimately, First Republic, had to be taken care of. And then they came in with this BTFP, which is the Bank Term Funding Program, to help these banks who had a very big mismatch in duration on their asset side. But that's probably the most recent one. But this is part of a much larger pattern, Tom, that goes back quite some ways. It's, what do you want to look at? You can start in many different places. I mean, there was, the repo blowout in 2019. There was the pivot in 2018 when, the market fell hard in that December of that year. There was last fall, I believe it was, when the British pension fund crisis occurred, and the gilts were racing to higher yields and the pound was falling apart, and the British had to reverse their policy and come back in with QE. There have been a number of other smaller things which don't necessarily come quickly to mind right now, but maybe they will as we continue this conversation. And just signals and signs that everything's not right in financial land, that that there are problems. Oh, one of them was the REITs. A couple of the major REITs in the U.S. had to gate withdrawals because again, real estate is a big problem, and that's probably one of the next areas to surface. I mean, we've seen it in the headlines, not in the financial market headlines, but we've seen it in some of the headlines where they're big landowners that are actually, or property owners, actually turning over the keys to buildings in Manhattan or in California, particularly San Francisco. A couple of very large buildings, they sold for, or they were worth less than the value of the mortgage, and so the owner just walked away. Mm-hmm. And so we're beginning to see the effects of this radical and aggressive tightening campaign that the Fed, in as late as 2021, told us would not occur. That they didn't foresee raising rates beyond, the dot plot was not beyond 1% within the next year. And of course, in 2022, they took it up to 4.7, 4.8. Now it's at 5 and change. So, it takes a little while when you make that kind of a move for it to filter through, but the filtering has started, and I don't think the filtering is over. I saw some numbers recently about the banks and how big the unrealized losses are on the banks. I mean, it's at least 500 to 600 billion, and it could be as much as 1 or 2 trillion. And many of these are smaller regional banks that aren't GSIB, so they're not necessarily guaranteed by the federal government. And so, it was interesting. I mean, Yellen, and when the bank thing went down, Yellen talked about maybe they'd have to backstop all the banks, which is $16 trillion worth of deposits. I mean, the FDIC fund is 130 billion or something. So, if Fed has to step in to save all the banks because they're failing, because their balance sheets are going upside down as a result of these interest rate moves, I think we can safely assume that there will come a time when the Fed will be forced by the market to reverse their policy. Of course, they won't say that because their job is to jaw bonus into all sitting tight. But we do know that their third mandate is financial stability. And, when things start breaking, they need to fix them. And they were able to fix this one pretty quickly with this BTFP. but perhaps if it gets to be a larger issue, they won't be able to fix it so easily. And I think there are a lot of factors coming together, and they're coming together in a way that something's going to break and we're going to hit the wall. I mean, and maybe this is a good time actually to go to the chart of how much debt they have to refinance in the next year or two. I mean, as most people know, the deficits continue to increase. Look at this. So this is the maturity of the U.S. Treasury debt. Look at how much of that is really this year and then next year. And I'm not quite sure whether this includes the deficit we're running this year. So if you'd have to stack another 2 trillion on top of the 6, but in either case, they're big numbers. And what you're seeing. I mean, I was checking earlier today, and I noticed the 1-year Treasury note is breaking out to a record high. I mean, the question that something like this begs is, knowing that the U.S. federal government is spending as much money as it's spending and incurring the deficits that it's incurring, who's going to buy this paper? Now, admittedly, it's attractively priced at 5%. That's a whole lot better than the ZERP that it used to pay. But there's a limit to the size of the balance sheet of the world, and higher interest rates make the problem worse, because another chart we don't have here, but anyone can look up on their own, is the chart that shows the rate of growth of U.S. federal interest payments. And several years ago they were in the $200-300 billion a year range. They're now at 800 and growing rapidly. So very soon, with these higher rates, the U.S. federal government is going to be paying over $1 trillion a year just in interest expense on the debt. And so the deficit, as these interest rates go up, the deficit only gets worse, which requires selling more bonds, which, as you know, I've referred to as a doom loop, or kind of a vicious circle. So it's a real problem. and these are rivets, I guess, is what I'm trying to say.
Mm-hmm. Larry, you've brought up the point many times before that the math just doesn't work. So
yes.
I think that works, that saying works in this case as well, where you can see that this amount of debt that needs to be refinanced, that kind of seems to me maybe to point to another idea that forces the Fed's hand in a way of needing to bring rates back down before they have to refinance at these higher interest rate levels. Is that a fair way to look at this?
Yeah, I think that's right. I mean, I think the ways that they can deal with this, I mean, they can do band-aids like the BTFP, which they claim is a swap and not QE, but if it's a swap that will probably never be unwound, so effectively it is kind of a form of QE. But they could also conceivably leave rates high and reverse the shrinkage of the balance sheet and actually start to become a buyer of the debt themselves, i.e., I'm suggesting they would pivot and return to QE. Mm-hmm. But all of these things have kind of a third world sort of look to them, in the sense that when you start printing paper to buy your own debt, that's a very dangerous thing for the value of the paper. Mm-hmm. And so they can try and hold the dollar steady with higher interest rates and hope the system holds together, or they can, let the dollar slide and print more, dilute the dollar, let the money supply start to grow again, etc. But in the end, to keep the system going, but in the process, they're going to have more inflation. Mm-hmm. And so this is why we all say the Fed is trapped, because they really are. They, mathematically, they're trapped in inflation has not returned to their baseline. Headline was 4, core was 5.3, and they say they care more about core, and the target's 2. So they're running it, over 2x their target, well over 2x, 2.5x their target on core, and that's a problem. So my view is, if and when they pivot, which they will, I believe the markets will force them to pivot. They don't want to admit that, and they won't admit that. And perhaps they'll have some ingenious scheme that I haven't thought of to kind of keep the whole thing going. I mean, that's what they've been relatively good at doing, and I don't discount that as a factor. That they'll create some new program with some new name. I mean, the BTFP thing was just spun out of whole cloth. And she one morning on 60 Minutes, or Sunday morning on CBS, she said, we're not going to bail out these banks. And then that evening they announced the BTFP, which was a complete bailout of the banks. Mm-hmm. So one can, I think we can assume that they've got their calculators out and their thinking caps on. They're trying to figure out everything they can to hold the system together with a, holding and try to get inflation down and maintain, a sound dollar. But as you pointed out, I've said it many times, many have said it, it's not original thought to me. The math just doesn't work. It just plain does not work. I mean, unless we have some kind of a productivity miracle, and we get, raw fusion or energy becomes free. I don't see how they get out of this trap. I mean, what they're hoping, I suppose, is that the economy slows down enough and brings the inflation down enough that they then have cover to pivot. And it is possible. I've dissected the inflation numbers. We probably are going to get some lower inflation prints. Not to say that those are really the true inflation, because we kind of know that all these numbers are somewhat made up. And frankly, that's another point I'd kind of like to make. I mean, I think we're in enough of the end game stage right now that my view, and from time to time personally and otherwise, well, I want to be long things, I want to be short things, I want to trade around things. This is all so manipulated and also screwed up that I honestly think that the only thing to do right now is to hold on to sound money for dear life, knowing that on the other side of it all, we'll be very well rewarded. But between here and there, there are going to be these wild swings, like the Weimar chart that so many are familiar with, that Dan Oliver did, that shows kind of the red line, zigzagging back and forth as they do these crazy policies and as the rivets pop. So it's extremely, I mean, guys as smart as Stan Druckenmiller, who's a billionaire and one of the best investors of our era, says, I've never seen such a confusing macro environment. And I have to agree with him. I mean, I haven't either. But fundamentally, so then I go back to core principles. The core principle is you can't print gold, you can't print Bitcoin, you can't print silver, you can't print oil. These are energy-driven forms of money that cannot be printed. Mm-hmm. And what's wrong with the system, as I think we all have seen and know, is that the money is broken. They broke the money. It's slowly been getting broken since '71, and that breakage has accelerated very rapidly. And the COVID printing was grew M2 42% in 2 years. That was pretty significant. And then they did one of the fastest rate hiking cycles in history, as just done now. And so it's quite difficult to know what the next move is. I mean, we could and a lot of our stuff's getting beaten up, and that's no fun. But I would encourage everybody to take the long view. Know why you're in this stuff, know why you hold it, recognize that we're right. I believe strongly that we're right about the reasons we hold it, and so therefore it's going to work. But if it works tomorrow, great. If it works in 6 months, okay. It could take a year or two to work. I mean, it's not, it's very frustrating waiting. But in the context of saving all your wealth, you'd much rather be in this thing, because it might when it does go, it might happen pretty quickly. And if you're not here, you're going to miss it, or you could miss it, I should say. Mm-hmm.
So Larry, as we're thinking about the government, as you mentioned, needing to buy its own debt here, have we seen a lot of instability in the bonds? And is this just another symptom of the debt and interest issues that we have?
I mean, that was in my last letter, which anyone can download from my website. I mean, we saw enormous volatility to be honest with you, I thought the Silicon Valley Bank thing was going to have a much larger impact on our stuff. And I thought, okay, here we go. The next leg up has started. And, credit to the other side. They kind of managed to calm everybody. They calmed the herd down, and they stuffed it all back in the box, with the BTFP and everything else. And, they're pretty good at doing that. But yes, the bond markets had an enormous spasm when Silicon Valley Bank failed. I mean, the report I've got shows some charts that, we had multiple standard deviations outside the norm. I mean, they could not have happened unless there was severe distress in the bond market. And I think that's really the clue. I mean, that's the thing I probably watch more than anything else. I mean, I watch the stock market too, but to me, the bond market is the whole issue, because, when people come to the point where they recognize that the inflation is intractable and that they're not going to really get it truly under control, and it's going to continue for years, then the bonds are mispriced. And so interest rates will have to go substantially higher. And, that will bring on a downturn in the economy, a downturn in the stock market, a negative wealth effect, and all the kinds of things that, bode well for the stuff we own. So it's common. it's coming, but we're not quite there yet. I will say one of my best technical analysts is very, very close to issuing what he calls a tier one gold buy. And the only times these have triggered, it was like at the bottom in 08 and the bottom in 2020 and the bottom in 2015. They're extremely rare, and he's right on the cusp of getting one. So I feel like, I tend to feel like this is going to happen in 3 to 6 months, but I don't want to be disappointed. It could take a little longer, but it's coming. You can feel it. I mean, the sentiment in the sound money camp, is generally speaking, dead, as we discussed before the show.
Yeah, it's almost it's maybe even worse than dead. It's extremely negative, which I think
Right.
those extremes, as you're saying, are times to really pay attention to those.
Well, that's right. I mean, I think I said to you before the show. I mean, I feel like shit. I mean, I've got that kind of I want to throw up view on gold stocks in particular, and I've been in them for quite some time, so I felt this way before. And generally speaking, it was actually a pretty good time to be buying. I mean, last time I felt this way was I felt this way twice. I felt it at the bottom in 2015, and then I felt it again on the really rapid drawdown in March of 2020. And in both cases, those were very good times to be in gold or gold stocks.
So, Larry, is the Fed really compounding its mistakes with every move it makes to you?
Yeah. I mean, honestly, some people have asked me, well, if you were them, what would you do? I said, I'd resign. Yeah. I mean, because I think you get into a position where if you're in a kind of a lose-lose position, almost anything you do is a mistake by definition. Some set of people is not going to like you. I mean, the people who want to have their money maintain its value, they probably would, they're okay with this. And if the economy tanks, so be it. And their view is pay me higher rates. I mean, I know some very wealthy people who are like, hey, this is great. I can get 5% on 3-month treasury paper. It's risk-free. I know now it's I should say it's nominally risk-free because the treasury will issue the paper and pay the 5%. What you don't know is if, we'll have a sudden revaluation of the dollar, which will make that 5% and the principal, have a lot less purchasing power. So there's some people who like it, and then there are others who are, meanwhile, the higher rates are killing them, and they're seeing their business about to get blown up, and they're sitting there saying, if you guys don't cut these rates, you're going to lose the entire XYZ industry. And by the way, I mean, part of the problem and part of the inflation problem, it's not just we printed too much money problem, although that's part of it. It's also a supply problem. And, COVID restricted supply, cut down supply chains, et cetera. And so you have less goods coming to market. Well, that's going to lead to higher rates or higher costs and higher inflation. And the way you solve a supply problem is you bring on more supply, which involves investment and capacity expansion. Well, investment and capacity expansion require CapEx. CapEx generally requires borrowing. And if the cost of borrowing is higher, you're not going to make it. So we've kind of got it coming at us from both sides. And as I say, I think the Fed is very badly trapped. And I think that, the credibility is at a record low. There's a chart on that somewhere in my Twitter feed that shows it's down. I think it was in the incrementum report. I think it's down to 30 some odd percent. And I think before this all over, their credibility is going to be zero because, they're going to have either a complete collapse or a very severe inflation. Because, it would appear to me that that's the direction in which we're going. They seem to be pretty good, though, at keeping us in between those two guardrails. I mean, like I say, I expected Silicon Valley to be a bigger deal. I mean, I think it was a warning sign, maybe to make it a comparable. I was around in 07, 08, and, I remember the Bear Stearns funds blowing up in the summer of 07. And I remember Bear Stearns going bankrupt in March of 08. And, each of those seemed like a pretty big deal at the time, but they kind of put it all back together again. And then the GFC broke out in, September, October of 08. So, to me, these are the kind of rivets popping or early warning signals of financial distress that I believe are going to lead us to something that's much bigger. As I say, I mean, if you took the Bear Stearns example, maybe 6 months later, and it could be 3 months, it could be a year later. I don't know.
Yeah.
None of us know. But what we do know is that the world was not set up for these higher interest rates. Look at all the banks. Look at the losses that these higher interest rates are causing are substantial in a lot of different places. And so, and that's going to be economically negative. And right now the Fed is focused on its keep inflation under control mandate. I think as a political organization, they could rather quickly flip into a keep the system together, stop an economic collapse kind of mandate. And I have no doubt that if those things were the issue, they would go right back to what they did in March of 2020, which was to just come in with everything and flood the system. And, our stuff would absolutely go bananas. I mean, gold would be at 3,000, almost instantly, and Bitcoin would zip through 100,000 and silver would zip through $50. Mm-hmm. So I think all of those things are imminent. What's kind of cruel about it all, or sick about it all, is the way these guys who are running the system can yank us around like this. I mean, it's kind of it's almost like economic whiplash. They can. I mean, they clearly have. They've made so many mistakes. They clearly should have discontinued the QE and discontinued ZIRP well before they did. When they were saying things were transitory, you could see what was going on, and they waited too long, right? And they let the bubble get to the insane levels it got to. And then once they realized they had that, now they've gone the other direction, and perhaps they'll wait too long here too. They're going to drive us into a very, very serious downturn, and then react, with the alternative. So it's, you can't help but wonder, do these guys really have a clue what they're doing?
Mm-hmm. Yeah. Larry, you also have a chart in that last quarterly review there that shows money supply growth, and how historically every time it has gone as negative as it is now, we've either had a severe panic or a depression. So yes. could these issues be solved with growing the money supply again?
I think they could be. I mean, you're going to have a different set of issues, right? I mean, the issue here, Tom, as you so well know, is that in a debt-based system with, the debt that's grown and the level of debt that we're trying to carry, there's really, it's the old saying, you can't taper a Ponzi. There really is no going back. Mm-hmm. We need to continually expand the debt, or at least keep it level in order to prevent massive downturn, bankruptcies, a bankrupt federal government, et cetera. And so if you don't, I mean, you can stop that for a brief period of time, and they have to some degree, as M2 has come down a bit, and they've been shrinking their balance sheet. Although, I thought it was very interesting. They did a lot of work in shrinking their balance sheet from February of 2022 and all the way into the Silicon Valley episode. And then when Silicon Valley hit, 3/4 of that, they turned around and undid it instantly. Mm-hmm. Which just kind of shows you that they don't really know what they're doing. And when things get rough, they print. And so, they are going to be forced into printing, Tom. And I think that, by the way, I think that's what the market is saying and knows as well. I think that's why the stock market's held up as well as it's held up. I also think when you look at the Fed futures, thing on CME, on the CME site, what you can see is that in spite of the fact that the dot plot shows they're going to hold rates high at this level for quite some time before they start to trend down, that's not what the market's betting. The market's betting that something's going to happen, something's going to break, and they're going to be forced to cut rates relatively quickly. Mm-hmm. So, and I think, and you can bet that the market has a better sense of what's really going to happen than the Fed, who's kind of working off an agenda of what they'd like to have happen. So.
Well, with the Fed raising interest rates with the intent of, trying to cool off the economy, I think the stress on the consumer is something that is evident to many people. Food inflation has taken many household food expenses almost doubled over the past 3 years. Never mind, yes. Interest rates and their effect on people's mortgage payments. So something that I think was off the radar as well was that the student loan forbearance is set to end on October 1st. So does this just mean more stress for the average person, and in a small way, a recognition by the financial system of the situation that the debt ultimately has to be paid?
Yeah, absolutely. And yeah, I thought you might bring that up. And I think that's a very good point, because that's put a lot of money in the pockets of younger people who have those debts. And it wouldn't surprise me, again, though, I mean, we're not at October yet, and it wouldn't surprise me as we approach it. And, October is, well, maybe a year away from the next election for them to kick that can again.
Mhm.
just because that's obviously when you're living on the margin and you owe a couple $100 a month, in student debt, and it's been in abeyance. That's nice. When you suddenly have to start paying it, that's tough,
Mhm.
and so it would not surprise me to see them kick that can down the road. But yes, I mean, I think the consumer everywhere is getting squeezed, and to date, the release valve, I think, has been credit card balances. I mean, I don't have the chart in front of me, but the U.S. consumer credit card debt outstanding has just been on a tear, and so people are feeling the pinch, but they're basically putting it on their card and paying the minimum.
Well, I
You
know
know,
I know the last time I looked at that chart, it was at an all-time high, nearly I think it was just under $1 trillion.
that's right. And if you had the slope of that chart, it was steep.
Mhm.
And so that works for a while because the minimum is typically a small percentage of the total, but eventually the total gets to be large enough that even the minimum's hard to make. And then it's like, oh my God, I gotta really cut back here in some way, shape, or form, or else I'm going to go bankrupt.
Mhm.
And it will, like I say, you can live off your cards for a while, but you can't live that way forever. If expenses exceed revenues for long periods of time, eventually an adjustment has to take place.
Mhm.
I mean, interestingly, the federal government's in the exact same position. I mean, the federal government looks like those credit card borrowers, right? I
Yeah.
mean, you know, and to me, that's actually going to drive part of the problem. I mean, the federal deficit now is running at a 2.1 trillion annual rate, and if the economy slows down anymore, the stock market falls anymore, or social payments go up anymore, or Social Security adjusts up again in a large way like it did last time, we could easily see, in my opinion, a deficit of 2.5 or $3 trillion. And again, that gets added on to those deficits need to be financed with debt. So that's going to be more strain on the debt market, which is then going to push interest rates even higher, which then puts interest expense for everybody even higher. And eventually, what's really going on here, Tom, is you know there are a lot of people and entities that are bankrupt. They just haven't recognized it yet. And I mean, in my opinion, the federal government is one of them. But because they are the federal government, because it is the reserve currency, because they can print it, they're not necessarily going to have to recognize it in terms of a bankruptcy filing. What they'll recognize it in terms of is, okay, we're not getting these bonds sold. We need to do yield curve control and buy them ourselves. We need to do QE to buy them. Whatever it is we need to do, we've got to, and/or maybe we need to cut interest rate, bring the policy back where we drop the interest rates lower, because as it is right now, the math does not work.
Mhm. What does that do for foreign demand for US bonds and treasuries, Larry?
Well, I think it's
At
the
that
same thing. I think it's the same story. I mean, I think they see what's going on here, and they're not stupid. But to be fair and to be frank, and to give Brett his due, a lot of those countries are in just as much trouble, or it's worse. I mean,
Mhm.
I noticed the UK inflation is just out of control. They came in hot again today. So, but I mean, to me, I've always said that I don't really care about one piece of fiat versus another piece of fiat. I mean, I don't care if the euro is better than the dollar is better than the yen, or either are better or worse than the pound. I think it's the money outside of the system that to me is the measuring stick, right? I mean, an ounce of gold is an ounce of gold. You can't print it. One Bitcoin is one Bitcoin. You can't unless you mine them, and we're already at 19 million, so there aren't that many left to be mined. You can't just out of thin air create a Bitcoin. So to me, the warning signals and the tell of when the next wave is starting will occur when Bitcoin takes out 30, 40, 50, and gold takes out 2100. I mean, gold, the chart on gold, Tavi Cost on Twitter has a great chart that I reposted recently that shows kind of a triple top on gold with an upward focus. And in my opinion, gold is going to take out 2100 sometime in the next 6 months, and when it does, it's going to run hard. And I'm not sure what the catalyst for that will be. I think it'll just be the recognition that the bonds are in trouble, and that the Fed. I mean, even before the Fed pivots, gold will smell it. I mean, gold smelled it in 2018 and 2019, even before all the printing that followed.
Mhm.
Gold smelled it, and gold broke out through 1365. And so, that's what I watch. I watch the gold cross. because and frankly, gold also smelled it before Bitcoin, although Bitcoin ran harder and faster. So, you know, that's what I watch when you talk currencies. I really talk, hard currencies or relatively hard currencies as against all these fiat currencies, which, are just, in my opinion, they're all doomed longer term. I mean, the only debate is about what the time scale is.
Mhm. Larry, I want to go back a little bit to talking about the average consumer
Yeah.
and how maybe the assets are held by demographic in this country. Does this create
Yeah.
a vulnerability with how these different age categories hold their wealth?
It really does. I mean, I think, there's a chart. I'm sure you're going to show the chart. There's a chart that shows where the money is. And, it's, I think the boomers are most at risk for a couple of reasons. One, they've got the largest piece of the wealth. So numerically, they're most at risk. But more importantly, the average boomer's earnings power is gone. I mean, when you're 65 years old, not all of them, but it's, many boomers are 60 plus. They're not working, or they're not able to work. They certainly are not in their peak earning years unless they're the CEO of a big company or something. So, and they may not have a lot of years left, but they also they have less time to recover if something goes wrong with their financial assets. And
Mhm.
so, what intrigues me is that because of the way the stock market has worked and even the real estate market has worked, you can see that the two biggest categories that the boomers own are equities and real estate,
Mhm.
and they own a ton of them. And I think there could come a time when, both of these assets worked very well in a deflationary environment, which we had for 40 plus years. But, to me, the problem with equities is that they're based on, the earnings power of businesses, which I think are going to be hurt badly by inflation. And the problem with real estate is you don't own it really free and clear because the state has a first claim on it with the taxes they put up. And the states need more and more money all the time. And it's gotten to the point where, the property taxes on a lot of good real estate properties really diminish their value on a go forward basis. And so, in my opinion, all generations are at risk, but the millennials have the most time to recover. The silent and the X generation, they're still silent or the silent is the much older. I'm sorry. That's my father if he was alive. No, the silent, they're on their way out, but Generation X, they have a fair amount of time, sometimes have a fair amount of time to recover as well. At least they're not at the peak. They're in their peak earnings years, but they're not past their peak earnings years. But the thing that I find most interesting about this chart is there's 140 trillion of wealth. 78 of it is controlled by boomers. The tradable gold, and most of that's in equities, real estate, pensions, and so forth. The tradable gold, durable assets, I believe, includes gold. The tradable gold, there's 12 trillion of gold in the world, but a lot of it's in jewelry or in museums. Tradable gold is closer to 3 or 4 trillion. And tradable Bitcoin is 500 billion, and tradable silver is less than that. So the assets which protect one from inflation are a very, very small part of the total assets, and it will not take a lot of as these boomers come to realize, hey, inflation is really a problem. I need to protect myself against it, and equities and real estate just aren't getting the job done the way they used to. That money is going to come into our stuff.
Mhm.
And it's already started, but we're still in the very, very early days. And I still think there's a large piece of the population that really believes Powell when he says he'll get inflation back to 2%, and that, we're going to go back to a Goldilocks environment. I mean, the 5x5 inflation swaps are still in the low threes. So, that would imply to me that, the world has not adopted to what I believe to be an inflationary trend that has a number of years to run before we slay it. And so, I think all of these categories are woefully underexposed to inflation hedges. And right now we're in one of those periods where inflation is coming down. So people are like, well, why do I need an inflation hedge? It's going in the right direction. But that could change very, very quickly. And when it does, it's going to make a huge impact on the price of gold, the price of Bitcoin, and the price of the gold miners, particularly. In fact, I think we ought to go next to your chart, or the chart I sent you about, just how badly the gold miners have performed as against gold. I mean, there is no more hated category in the stock market today. And admittedly, gold mining is a tough and shitty business. You're breaking rocks, you have to replace what you take out, etc. But having said that, you've got good companies trading at very low multiples of cash flow. And if you look at what's happened since 2018 here, the price of gold hasn't done all that poorly. I mean, it doesn't feel great because we've kind of been stuck in this range since 2020, the peak in 2020. We bumped up against it when the war broke out in early 2022, and we bumped up against it earlier this year. But the fact of the matter is that the gold price has done pretty well. But look at the gold stocks. They've really gone nowhere. And so to me, this is a multi-generational buy opportunity in the gold stocks. And, they say bull markets try and shake off all the riders. Well, I don't know many people who own gold stocks who aren't completely disgusted, discouraged, and ready to be shaken off. And you might think, well, okay, there's a reason for that. And therefore, I don't want to own gold stocks. I tend to look the other way at it and say, no, I'm a contrarian. What that suggests to me is that when this next leg up in gold starts, people are going to wake up, they're going to do the math, they're going to say, holy shit. And the gold stocks are going to take off like a bat out of hell. So I think that, I think that's coming, as I think I alluded to earlier. I can't tell you if it's in a month or in 18 months, but I do think it's something that's coming.
Mhm. Larry, is there any reason to doubt that hypothesis? When we think about what could go wrong.
Yeah, no, there are a lot of reasons to doubt it. I mean, nothing in investing is certain. And people often ask me, they're looking at my fund, they say, what could go wrong here? Why don't I want to do this? And I'll tell you, I mean, and they laugh when I give them this answer, but I'll give you my honest answer is that if the government were suddenly to get responsible, okay, and I'll just give you some examples. Let's say they decided to means test Social Security. Let's say they decided to cut the military budget in half and disengage in a lot of the military adventures that we've undertaken. Let's say they decided to actually legitimately cut spending and start to bring the budget down. Let's say they decided to raise taxes, which nobody would like, but which would again indicate a trend toward fiscal responsibility at the US federal government level. That would suggest to me that what I'm talking about, which is kind of a doom loop on fiat currency, is either delayed or is going to take much longer, or maybe not even occur. I mean, I happen to think we've passed the Rubicon, that we cannot go back to full. We can't. I mean, the numbers are just too big. I mean, the unfunded pension liability, or the unfunded liabilities in the United States are close to $200 trillion. I mean, this is on an economy of $25 billion or $1 trillion of GDP. I mean, that's just it's insane. And so unless we're going to break all those commitments, and raise taxes, I don't see how we go in the other direction, or how this proves out to be wrong. But it could. I would say another thing that could potentially occur that would be a negative for our side in the shorter run, but is government tax policies could decide to go after, sound money, and try to again to they've already, to a degree, they try to block the exits. They put their policies in place. They want you to do certain things, and then they try to block the exits. I mean, in the crypto world, many people have probably heard about Operation Choke Point. I mean, they've gone after Binance, they've gone after Coinbase, they're suing a lot of people. They basically are trying to do everything they can to prevent people from participating in crypto because it's an alternative to their fiat system. And so there are ways that they throw sand in our face consistently, but in turn, I think we will ultimately prevail, because I don't think that any of the policies I described are something that they're going to be able to pull off without having some kind of a revolt, on the part of the country.
Mhm. Yeah, it's going to be some interesting times here. And I think, keeping that perspective, especially through what is probably going to feel like a dull, boring summer, is going to be important. That all these problems still exist, that nothing is going to be resolved because people are on vacation. And this, you know, what I have, and I'm sure you have experienced the summer doldrums, doesn't necessarily mean that everything is okay.
Correct. And I think you've got to also consider just what I would call, quote unquote, the surprise factor.
Mhm.
None of us knows what it is or where it is. I mean, one day Silicon Valley Bank was in good shape. 2 days later, it was bankrupt. One day the Soviet Union was the Soviet Union. You know, then it fell apart. And this they really have got a fragile, levered, fraudulent financial system where they're lying about all the numbers, and they're putting their finger in the dike to try and prevent the water from getting through. And somewhere that they don't even see yet, the water's going to come through, and it's going to be a big one. And then they're going to have to scramble like crazy. I mean, it was interesting to me on the Silicon Valley Bank thing how much kind of quote unquote panic I saw on their side. They opened up swap lines on a Sunday night because they were afraid of the Swiss bank failing. It's Credit Suisse, right, failing. Yellen said she was going to back out all the banks' deposits. Nope, then she wasn't. Nope, then she was. Then she wasn't. I mean, they're unforced errors, and you can see, or you see the questions that they asked Powell, regarding, are you going to monetize this debt? And he just kind of cold stone face says no. I mean, that guy's not getting invited back to the next press conference, right? I mean, look, they know what they're up against, and they're trying to develop tools to hold it all together. And we know they're lying. They know they're lying. They know we know they're lying. And we just got to hang on. We just got to stay in the stuff that we know is right. And we got to recognize that big changes. I mean, when this changes, it'll all completely and totally change. And there won't be. That's the thing to consider. Everyone says, "Well, I'll just wait until it happens, and then I'll do it." Well, okay, that might work, but it might also be the case that you wake up one morning. I mean, Rickards has this great ICE 9 theory. He talks about, you wake up one morning and gold is $5,000 bid and there's nothing offered. Do you know what I mean? Because the system is literally coming unglued. I mean, it's not impossible. There could be some news event that leads to, just a massive loss in the system. And the one thing we know today, compared to these panics in the past, is that we are all so interconnected digitally and instantaneously. I mean, how did Silicon Valley Bank? I mean, I think what caused the run there was one of the larger venture capitalists out there said, "Hey, I'm looking at this thing and thinking maybe it's not so good. Hey, portfolio companies, why don't you guys all take your money out of Silicon Valley Bank?" And boom, on one day, $42 billion went out of that bank in one day. I mean, holy shit, that's contagion. You know what I'm saying? Think about that model applied to anywhere else. I mean, think about if one day the Chinese woke up and said, "You know what? Fuck fuck America. They've really pissed us off. All these treasuries, they're for sale. All of them. I mean, all 800 billion that we own, or 600 billion, whatever the number is now, they're all for sale." Well, the treasury spreads would blow out like crazy, and everyone would say, "What the hell's going on here?" Do you know what I'm saying? And then who would be the buyer? Who would step in front of that and say, "Oh yeah, well, I'll buy some of those treasuries"? Nobody.
Well, that's the thing. Who buys them if they all go on sale at once? And what does that do to the value of those treasuries?
Well, that's right. And the answer, Tom, as you know, and as I know incredibly well, is the buyer of last resort is, and it's because the way they've constructed the system, the only buyer left is the Fed. And so the Fed says, "Fine, we'll take all you got." And the next thing you know, the Fed balance sheet is no longer 8 or 9 trillion, it's 18 trillion, on its way to 20, because the entire bond market has said sold to you, right? And then everyone thinks, well, shit, if the bond market's failing, then the currency's failing. Well, okay.
Which I was going to say, nobody wants your US dollars at that point.
Well, that'd be right. I mean, it'd be like, well, shit, if the bond market's failing, that means the currency's failing. That means, okay, I don't want to be in dollars. Oh shit. Well, I could buy some real estate. Okay, great. I'll go do that. I guess I could buy some stocks. And by the way, in hyperinflation, stocks do go up, not in real terms, but in nominal terms, they go up. So there'll be a big bid probably put onto the stock market. But the next thing you think is, okay, what can I buy that the government can't print? Let's see, maybe gold, maybe silver, maybe Bitcoin. I mean, that's really, it's a pretty short list, right? And so again, and those are going to give you price signals. So, I mean, how would the world react if gold opened up one morning at $3,000? I mean, and isn't that the same as everybody counting? I mean, it's a contagion, right? It's a fire inside a theater, and the first guy yells fire, everybody in the theater says, "Get me the fuck out of here."
Yeah.
Right. And so, so it's entirely possible that same kind of thing could happen, except the scale we're talking about could be at the level of the sovereign currency and the sovereign debt. That's the point I'm trying to make. I'm not saying this is going to happen. I'm not trying to be a fearmonger. I'm not trying to be a doomster. But what I'm saying is these things we do know these things are troubled. We do know that, the government is bankrupt. We do know that they've expanded their balance sheet massively. what makes us think that they're going to reverse it and get it all under control? I mean, I don't see any evidence we're going in that direction. So, all right, I mean, gradually, then all at once. Well, we could just kind of be waiting for the all at once part here, right?
Mhm.
And I think the all at once part is kind of coming between 2025 and 2028. That's kind of my best guess. I mean, they'll keep putting on band-aids. They've got more, bank term funding programs, or as I like to call it, buy the fucking paper, right? I mean, they've got more of that stuff coming, and they'll keep doing that kind of stuff. But eventually, enough people realize that these are just band-aids. The fundamental problem is intractable, and it's going to continue to get worse. And therefore, okay, please, I'll take that gold and silver or that Bitcoin, please. Thank you very much.
Mhm.
That's my view of how it happens. Again, the time scale, who knows? Who knows? I mean, I doubt we make it to 2035 without a major monetary reset. And my base case is it probably happens in 26 to 28, 2026 to 2028.
Mhm.
But I mean, I say take all this with a complete grain of salt, because in 2008 I thought it was all over. Okay, and I was totally dead ass wrong.
Mhm.
I mean, they said, okay, fine, we'll just print the money to solve the problem. And it's like, oh well, that's different. And so, maybe they have something similar up their sleeve. I mean, certainly people have alluded to maybe the CBDCs. Maybe they put in a whole set of laws. You can't buy Bitcoin. You can't buy gold. We're not going to let you out that exit.
Mhm.
Now if they do that, I think the screaming you're going to hear, I mean, it's kind of going to be, it's French Revolution time, I think, at least I hope. But yeah, maybe not. Maybe people, okay, yeah, we got to do it to save the system. I don't know. I mean, I do know that I sleep well knowing that my wealth is held in money or money substitutes that cannot be controlled by the government. I mean, they can put up laws around them, but they can't actually manipulate the amount of gold other than paper gold. But they can't print ounces of gold, and they can't, they can make paper Bitcoin, but they can't actually have Bitcoin
Mhm.
that they self custody, the way I do it. So
Mhm.
that's kind of how I see it. You know.
Well, Larry, I think that's a good place to kind of wrap up for today. We touched on everything that I think is important to at
Yeah.
this
Thanks,
point.
Tom.
And
Again, I'm not trying to be apocalyptic, and I don't, I don't wish any bad on anybody or any country, but I don't see how, with a set of circumstances that we don't have a monetary crack up somewhere in our not too distant future,
Mhm.
because unless they reverse the policies they've got, which is a possibility, a real possibility, but we don't see. I certainly don't see any evidence of this. I mean, look at what the Republicans just did. What are they going to 7% of the budget? They're going to freeze it for 3 years. I mean, that's kind of like they're trying to put a band-aid on a gaping wound, right? It's
Mhm.
nothing. So, but again, thank you for having me on the show, and thanks for the time.
Yeah, thank you, Larry. I always appreciate sharing your thoughts with us. Of course, on Twitter at Lawrence Lepard and EMA2.com, right?
Yep, absolutely. And feel free to reach out if you have questions.
Perfect. Thanks so much, Larry.
Thanks, Tom. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.